Question 3, Tracy. Page 81. Tracy has $165,000 worth of assets, $130,000 in liabilities. It's actually a pretty straightforward question. What is Tracy's net worth? You didn't even have to figure out what are assets, what are liabilities when it comes to her, financial situation. So net worth is always assets minus liabilities. This formula you must have on your study sheet. So it's 165,000 minus 130,000. This is not the part that I think you will struggle with. But remember, the net worth can be negative. If you have more liabilities than assets, your net worth is negative, okay? So in this case, it would be $35,000. B is the one I'm curious to see what you would do with that. So Tracy borrows $16,000 to purchase a car. We're assuming that the car, right, is $16,000 and you're borrowing $16,000, right? So this is what's happening here. Your assets increase by $16,000. That's the car, right? So you're like, hey, I've got a car. Now I have $16,000 worth of assets. But liabilities also increase by $16,000. And that is the loan, right? You're borrowing money. So what do you think is going to happen to your net worth? It's not going to change, is it? It's going to stay the same. So basically, I'll go assets would be 165 plus 16,000. I will use my calculator because I don't want to get this wrong today. Assets is 181. Liabilities would be 130 plus 16,000. And that would be 146,000. Your net worth is 181 minus 146, and that's still going to be 35,000. So no change. No change. So I thought that'd be a good one too. To try. Another one, the formula that I would like to clarify, we're going to go back a little bit. We're going to go to 78. So if the province or I ever ask you, what's the maximum someone can be spending on housing? You go 0.32%, or so 32%, which is 0.32 times the monthly income, right? This number, when you crunch this, it would be the mortgage payment, heating, and property tax. So those three combined is what we call housing, like what you spend on housing. Okay? So if it's just housing, 32% of your income, boom, you got it. That's how much money you can spend on these three things. Okay? But if the province ever asks you what's the maximum mortgage payment, like just the mortgage payment, then we take the maximum we can spend on housing, which is calculated as we showed here, and you subtract the monthly heating, and you subtract the property taxes. Like you subtract these two components that will be given to you, right? And then you know, okay, that's how much I can spend, like in terms of the mortgage payment alone, okay? So these formulas are kind of tangled, right? They're tangled up. So technically, we could, under this, just write 0.32 times monthly income. Right? Like this maximum housing, if you want to just place that in there, that's fine. If you want to replace it. Okay. Anything else? Are there any questions you have for me that you need me to clarify? I'm not going to spend a lot of time on financial ratios because I'd rather spend more time on TVM solver. Most of these ratios are just like plug in and go and make sure they're all in monthly amounts, especially when it's the GDSR and the TDSR, right? Make sure everything is in monthly amounts. Very important. And remember your magic numbers. Basically, you always want to be below those, below the magic numbers. That's the safe ratio to have. All right. I'm going to give you a couple minutes to try a question here. How about we go to 82, you try question 6. Try question 6, see if you can do that. It's not my writing. It's worse than my writing, I think. My bad. I'm gonna try to update that key. So total of Joyce's liabilities. I'm just gonna go through it real quick. House, vehicle, credit card balance, short-term loan balance, and mortgage balance. These are my liabilities here. And if you add them up, you get $245,000 would be your liabilities. Okay, that's all it's asking for. For some reason, it doesn't ask for assets. What is the DER? What do we need for the DER? We need, right? If you look at the formula for DER, you take liabilities minus mortgage divided by net worth. So we know the liabilities, we know the mortgage, but we need to figure out the net worth. They didn't ask us for it. So I will do that first here. My assets, can somebody tell me are the assets 417? Is that what we get for all the assets added up? Okay, I see a bunch of nods, so I'm just going to go with it. I need to know my assets for net worth purposes. Okay, so net worth is simply 417 minus 245. So if you subtract them, you have a net worth of 172,000. Okay, so this is definitely something I need to come up with a debt equity ratio. So now I can do my math here for B. This is B. This is A. Basically, liabilities are 245. So I'm going to go liabilities 245 minus the mortgage. Right? And then you divide that by your net worth. multiply your answer by 100. If you do that correctly, my key says 11.63%. Is that correct? Okay, circle that. Please, when you give your final answers, also on the TVM solver, please circle your final answers. Very important. Units and circle. Because the province wants to know, like, you know which one the answer is. Okay? I know we're doing the dot thing, but I would say circle. Okay? Explain whether Joyce DER is an acceptable level. You would say yes, right? Yes, since her DER is below, and here's the magic number, 50%. Okay, like that's it, as short and sweet as that. Okay. So basically, what is the DER doing? One more time, it takes all of the what we call bad debt, because a mortgage is considered good debt. It's okay to owe on your house because the house goes up in value. That's why we remove the mortgage and we say, like, what do you owe in terms of credit cards, loans, all of these other bad debts, and we compare it to your net worth. And we don't want your bad debt to be bigger than 50% of what your net worth is. That is like, that's what the banks kind of suggest, right? That's what financial gurus kind of suggest for us, okay? Okay, we're gonna give this a pass. And then there was one question that kept on throwing students off. It's because I made changes to it and it didn't jive with the key. Yeah, the key is not doing, and I did tell myself, new question, update your key. But I obviously didn't. Okay? I missed that part. So let's do it together and then that'll be your key, right? A, determine the maximum amount Carrie can spend on the monthly mortgage payments. So this is where you go max mortgage payment. Let me give you the formula that I would have on my study sheet. Like maximum housing, maximum on housing can be translated as 0.32 times income. Monthly income, that is. Minus heat, minus tax. Okay, property tax, that is. That's how I find out how much I can spend on my maximum mortgage payment. Right? So let's do this. 0.32. The income is $3,800 a month. It's a monthly income. That's exactly how I want it. So I'm just going to go time. So this is going to give me how much I can spend on housing minus the heat is $150 and property taxes is $135 a month. 0.32 times 3,800. That's $1,216 minus 150 minus 135. $931. Okay. I will make a note here. Maximum spent on housing is $1,216. Like if they just asked you, like, how much can you spend on housing in general, it would have been just the $1,216. Maximum mortgage payment. I'm trying to think here. can I want to morph this into a question that could come your way. Okay? So we're going to get rid of question 8. I hope you didn't do 8 in this case. If you did do question 8, try to find a blank spot on page 84 somewhere. Just go arrow to page 84. But I'm going to cross this out. Cross this out. This is on page 83. And I want to do B, part B of this question. I just want to do that down here. Okay, because this one is important here. So I'm just going to do B right next to it. Let me zoom out a little bit. Watch what it says here. Carey's Bank offers a 3.94 interest rate, amortized over 20 years, compounded monthly. Calculate the maximum mortgage amount Carey qualifies for if she had a $70,000 down payment. We did a question like this before. But this is how we're going to solve this. We're going to go NI, PV, PMT, future value, PY, CY. This is the maximum mortgage amount that we're trying to figure out. I'm going to zoom back into that question. And how would you do this one? Well, let's start from the bottom. Compounding, it says monthly. Payments, what did we just find out? Like, what is this 931? That's the maximum mortgage payment, but it is monthly, right? It is a monthly payment, that 931. So we make this 12 as well. We want the future value, we want it to be 0. We know that our payment can be $931 a month. We just calculated that. What's the present value? That is what I want to find out. Like, how much money is the bank going to borrow me today if I'm able to make payments of $931? The interest rate is 3.94. N, I know it's 20 years times 12, so that's 240. And let's find out how much the bank will approve us for. Apps Finance, right? Do the thing. That's 20 times 12, 3.940. Negative 931, right? You're giving that to the bank. And both of these are 12. I'm going to go ahead and solve for present value. And there it is. $154,439.92 is what the bank is going to borrow you, okay, based on this. But it's maximum approved mortgage, house, right? House she can look for is present value plus down payment. So technically, the bank will give her this much money, but because of the down payment she has, she can look for a house that is more expensive. $70,000 more than that. Okay. So technically, she will be approved. She can look for a house that's $224,000 in this scenario, right? So I'm going to go arrow from the PV and just say, I took that, I knew that that's what the bank is going to borrow me, and I went and added my down payment to it, so that's how much I can borrow. Because remember, to figure out your payment, we would have subtracted the down payment, put it in there, and then figured out our monthly payment. Okay. I'm gonna stop there for now.